welcome. Thanks for joining us in the third in our series of videotapes on investment opportunities. We use this series to discuss changing strategies in the investment world that we think it's important that you understand and know about. Today, we'd like to show you why we believe the changing world we live in presents investment opportunities outside the United States. You know, on a personal note, I spent the last year visiting our clients and our offices around the globe, and the images that I have seen leave absolutely no doubt in my mind as to the investment opportunities that are likely to come from the growing growth of capitalism that's exploding around the world. Just think about it. A line of trucks 5 miles long waiting to bring manufactured goods from China back into Hong Kong for export. Or 6,000 people waiting patiently outside the Shanghai Stock Exchange to place their orders. Or turning on a television in a Chinese hotel room and seeing 10 channels featuring everything from the local Chinese channel to the BBC or to CNN or to HBO. There's only one conclusion you can draw. The world is growing smaller every day, and just as surely, there are immense opportunities available for intelligent investors. In the next few minutes, we're going to spend time talking about the changes that are taking place globally. We're going to talk about the changes that have already occurred and what they can mean to you and what they mean to your portfolio. Please join me as we look at the case for global investing.
A typical all-American morning. It may be typical, but as you can see, it's not all American. We live in a global marketplace. You only have to look around your own home to see it. Today, more nations are producing more goods for more consumers than ever before. An equally dramatic change is taking place on the political scene, as more governments are turning to policies of capitalism. But these transitions are not always smooth. Every morning, it seems, our newspapers carry stories about political instability in many parts of the world. How will the changing political landscape affect the progress of a global marketplace? Dr. Zbigniew Brzezinski, professor of foreign policy at Johns Hopkins University and a former national security advisor, gives his views.
To understand what's going to happen in the next decade, roughly till we enter the 21st century, it's useful to take as one's point of departure what has happened in the last decade. This, in many respects, has been the most vibrant, dynamic, discontinuous decade since the French Revolution. The French Revolution introduced into world politics ideological concerns, and much of this century has involved a struggle over the future of mankind between totalitarian concepts of coercive utopia and liberal democratic concepts of a pluralist society. We have won. The Soviet Union has disappeared. And as a consequence, paradoxically, we're now entering a world of considerable unpredictability. In that context, what will be very much needed, and this will have to be the major thrust of American engagement in the world, is the promotion of wider international cooperation among those sectors of mankind which in all likelihood will be reasonably stable politically and reasonably successful economically. And that above all means the three most advanced and promising regions of the world, namely North America, with NAFTA hopefully expanding. It means Western Europe, hopefully also consolidating its march towards unity and expanding its scope by absorbing the Central European countries, thereby increasing European markets and widening the scope of European stability. And hopefully it means the Far East, specifically Japan, Korea, and Taiwan, and if internal political changes in China are not overly disruptive, also drawing China into wider forms of international cooperation. Then on that basis, if you will, on these three large areas of regional cooperation, one hopefully can envisage an ink block effect of international cooperation gradually spreading and containing and subsuming the large islands of regional instability and conflict, the kind of regional Bosnias, which currently are posing a challenge to international cooperation.
Worldwide economic cooperation has also been identified as one of the key trends that will define the next decade by John Nesbitt in his best-selling book on global change, Megatrends 2000.
All of us have heard a lot about Single Market Europe 92, and that's really just a step to single market world. That's the direction we're going. You hear a lot of talk about trading blocks, Europe, the Americas, and Asia Pacific. These are not trading blocks, these are building blocks. We're building toward a world that's just one single market, one marketplace. An extraordinary thing. It'll take a while to get there, but that's the direction we're moving. Well, it means that economic considerations are overwhelming political considerations as we move toward the single market world. It also means that people are seeking economic security versus a kind of national security that we talked about for so long. It also means that countries all over the world are dropping their protectionist barriers. Mexico and Argentina for decades tried to create a self-sustaining economy, and it didn't work. And now they're among the most open economies in the world. Well, that's happening all over the world as we move toward one single market. And I expect before the end of this decade even that the great economic regions of the Americas, Europe, and Asia Pacific will form a free trade zone, a giant triangle of free trade. That would be 80% of the world's economy. That would pretty much be it. But see, that's the large overarching trend. It may take a while, but we're moving to a world where we just have one single economy, one single market.
The numbers would seem to support Nesbitt's observations. In 1970, total investment in the world stock markets was $921 billion, of which 66% was in the U.S. By 1992, total world capitalization had grown to $9.9 trillion, and the U.S. share had shrunk to just 41%. Consider that today, the 10 largest banks in the world are outside the U.S. The same can be said for 7 of the 10 largest automobile companies, 8 of the 10 largest utilities, 6 of the 10 largest airlines, and 7 of the 10 largest chemical companies. The trends that have driven these changes are followed by Bill Sterling, the manager of international economics for Merrill Lynch Research.
I think we've seen a trend towards globalization of both product markets and financial markets since the end of World War II, driven by the rise of Europe, the rise of Japan, better communications, telecommunications, computers, technology, and so on. But in the last few years, I think we've seen a real acceleration of this trend to globalization. And that, I think, is driven by the geopolitical changes since the fall of the Berlin Wall in 1989, the subsequent collapse of communism in the Soviet Union. We've seen basically a revolution in policymakers around the world in their thinking about how to organize and manage economies. If we look to Latin America, for example, where some of the changes have been dramatic in the last 4 or 5 years, basically all the policymakers are singing out of the same hymnal, so to speak, using phrases like privatization of the economies, reducing budget deficits by the governments, bringing inflation under control, opening the borders to trade and direct investment. All of these things are going on simultaneously, and it's not just in Latin America. The same is true in China. The same is true in India. Even in Vietnam, I think you're seeing a move in this direction. If you went back and thought about what we tended to think of the world economy as being 5 or 6 years ago, we really at that point were only thinking about the 24 rich industrial nations and then perhaps some of the satellites in Asia and so on, but about 1 billion people overall. If we think about the world economy now, there are at least 3 billion people, additional people we can identify as trying to enter the world economy. 1.2 billion in China, 850 million in India, another 900 million or so in Latin America. So really the size of the world economy as we know it has increased dramatically. And that I think is giving a tremendous spur to this whole trend of globalization. Not only of course in the markets for goods and services, but clearly in financial markets as well.
These dynamic changes in the world's economic landscape have created a number of clear financial market trends. Identifying these trends and analyzing them for investment opportunities is the province of Tom Robinson, the Chief International Investment Strategist at Merrill Lynch.
Well, as Bill was saying, we've looked at a large number of privatizations throughout the advanced industrial countries as well as in the developing world. We've seen trade barriers coming down, and we're literally seeing the world economy come together into one massive big trading block at one time. And I think this provides us with an exciting set of opportunities as we look forward from here. We have the advanced industrial countries, countries like the United States, like Germany, like France, and so forth, that are really looking to lower their trade barriers, and as they do so, there are many businesses have to become much more competitive on the global economic scene. And so this whole restructuring theme that we've talked to you about so many times from Merrill Lynch that we're looking at in the United States economy is becoming a theme that is pervading all aspects of the advanced industrial countries today, where they all must lower costs in order to be more competitive in this exciting new global economic environment. But then in addition to that, of course, we have the emerging markets of the world, where we're looking at countries like Malaysia and Indonesia, Mexico and Argentina and the like, where we're really seeing these countries starting to move much more aggressively toward participation in the global economic scene. And this is what's providing us with so much excitement. And between the two of these, this is bringing us forward, really, into a number of very, very key themes that seem to pervade all of these countries. We have a significant need for improved infrastructure, whether it's in the advanced countries so that product can be delivered from the coast to the interior more effectively, or in the developing world for the first time, seeing roads and telecommunications equipment and so forth put in place to really integrate them into the world economy. We also have, of course, with economic growth, greater energy use, and so energy becomes much more important, a finite resource with much greater energy needs going forward. And of course, with economic development, we also see a rising environmental concern and new opportunities in the environmental businesses. So we're looking at a large number of opportunities and situations that emerge internationally as a result of this globalization process. We'll just take one example, infrastructure building in Asia. Asia needs a huge amount of infrastructure. In fact, by our calculations, which are probably very conservative, excluding Japan from the total, we have announced infrastructure costs at the moment of something on the order of magnitude of $870 billion. Just think of the sheer size of that number, $870 billion, which will provide Asia with an upgraded infrastructure, which will include better roads, better highways, better telecommunications equipment, so that they will be able to deliver product and compete even more effectively in the world economy. So there are great opportunities out there as we see emerging themes around the world that make very good sense in this globalizing environment.
Infrastructure, telecommunications, energy, environment. These are identified themes which present opportunities for the global investor. Many investors have been satisfied with the return on portfolios invested entirely in U.S. markets. Why should they consider international investing? Dr. Kenneth Rogoff, professor of economics and public affairs at Princeton University, answers that question.
Well, it's true that if we looked at just last year, investing in the United States was a pretty good strategy. But on the other hand, if we look at other years, look at the past, Europe and Japan have done better. And in some years, Latin America and developing countries have done better. I think unless you're an investor who really wants to gamble it up and invest in just one asset and take a big risk, it's better to spread things around. I think the basic logic of global investing is simply this. You wouldn't necessarily want to invest all your assets in one company. You wouldn't necessarily want to invest all your assets in one state. Why should you put everything in one country? And the evidence is very strong that spreading your money around helps reduce risk. Well, it's a real puzzle why more of us aren't taking greater advantage of opportunities to invest abroad, to diversify our risks across other countries. And I think largely it's a matter that it's unfamiliar. We're not used to putting our investments in foreign countries. We're not used to these assets. And we're a little reluctant to do something that we're not comfortable with. I think there's a good analogy with money market mutual funds. If you remember, they were introduced 10 or 15 years ago. And I think a lot of us went through the process of thinking, well, I read about them in the paper and they pay a little bit higher interest rate, but I don't feel like figuring it out. And I myself, a professional economist, certainly knew about them, and I didn't take advantage of them right away. And I think something similar is going on with global investing today. There are more opportunities all the time to diversify your portfolio abroad. It's something that's getting easier and easier. And I think it's something that many of us will now begin to take advantage of much more than we have in the past.
While individuals may not have considered global investment strategies, the same cannot be said of institutional investors. In less than 10 years, U.S. pension funds have steadily increased their investment in foreign equities, from under $2 billion in 1979 to over $110 billion in 1991. One reason has been performance. During the same period, the U.S. equity market has only ranked 10th in the world's markets. So for a portfolio, a portion dedicated to international investment brings the benefit of diversification, as well as the potential for increased performance. A global approach to investing also takes advantage of the non-correlation of markets, which can decrease volatility in the value of a portfolio. Tom Robinson explains.
Well, I think probably one of the big benefits of international investing is the non-correlation between markets. Now, that's simply a big word for saying that we don't have all markets moving in the same direction at any given time. I mean, basically look at it this way. Somewhere, somebody in the world is making money at any given period of time, and that's essentially what we're trying to look to in getting international investing opportunities before us so that we can gain these opportunities to make money, whether we've got an up market or a down market. But basically the bottom line is, if the U.S. equity market is in a correction phase, there will be other equity markets that will be going up. Sure, there will be particular periods in the cycle of equity markets globally, like we were coming up into the 1987 crash, where all markets may move together over a brief span of time. But in general, on average, we find that markets do move diverse to one another, and therefore we simply get the opportunity to protect ourselves against downside risk, or what's even more important than that, even if our own market is going up in this particular period of time, but other markets are going up even more, it is a sign again of the same concept of non-correlation. We have even better opportunity provided by those markets.
Any program of investing begins with understanding the risks and factoring them into your investment decision. When looking at international investing, there are a number of risks to consider: political, economic, and currency. Bill Sterling.
Anyone looking at international investing often is concerned about political risks, because we all get these images that come in on a television set of a coup occurring somewhere, or of tanks in the public square, or all kinds of things that we associate with, and rightly so, with ups and downs in the financial markets. I think one thing that's important to keep in mind is that these type of political risks, from an investment perspective, often create political opportunities, so to speak, in the sense that if you think about it, perhaps one of the best times to have been buying Hong Kong stocks or China-related themes a few years ago was, in fact, when tanks were rolling in Beijing, June 4th, 1989. Investors who bought then have done very well. Those who panicked and who followed a herd mentality and sold out often end up regretting that kind of a decision. I think one other area of risk that people are concerned about, and rightly so, is currency risk. Because clearly we've had periods over the last several years when the dollar, for example, has taken off, and in 6 months it's gone up 20% against the European economies. If you were in a European investment at that time, you saw your dollar-based returns decline. But over the long term, we've found that that type of volatility tends to wash out, and it's good not to be too concerned about it. Often a foreign currency will be declining precisely because some other aspects of that currency, like higher growth rates, are creating inflationary pressures that temporarily unsettle the markets. But even if the currency is declining, you may be making more in terms of the local stock market. So I think that has to be taken in consideration as well. All the academic studies that have looked at the question of currency hedging or the risk of being involved in foreign currencies over a long period of time, saying it's best not to pay too much attention to it and ride out the wiggles and the waggles.
So when reviewing your portfolio, consider global investing. Your financial consultant is trained in the use of global investing to meet client needs. He or she can help you analyze your particular situation to see if global investing is appropriate for you and your investment objectives. As with most investments, the biggest equalizer is time, and global investors need to be long-term in their orientation and expectation. As we discussed, there are many investment opportunities throughout the world. Merrill Lynch believes that 3 regions hold long-term potential for investors: Europe, Asia Pacific, and Latin America. First, Europe. Accounting for 25% of the world's output, the European community passed a milestone in 1993 with the creation of a single market. Based in London, Alan Albert is a senior portfolio manager for Merrill Lynch Asset Management and focuses on European investment opportunities.
European investment, I think, actually has appeal in both the short term and the long term. The short term rationale is very similar to really what has pushed US prices and Japanese prices up in the last few years, essentially at lower interest rates. The European economies are very weak. Interest rates have to be cut at last, and we would see rates falling by a half or more during the course of the next 18 months. That is really going to be a very, very strong boost to equity prices. In the long term, I think the benefits of investment in Europe will really come from the harmonization process. The collection of European countries in one trading bloc, taking down the trading barriers, allowing companies to become more productive, more efficient, and therefore to increase profits. From a particular standpoint of stock market investment, I think the appeal comes from the privatization process. There is politically a move in Europe to the right, a move much more to the capitalist-type system. That really will mean that governments will take companies out of the state system to move them into the private system to allow them again to become more productive and more efficient. Normally, this occurs at relatively undervalued levels. If we go back to the experience in the UK, which undertook this process 8 to 10 years ago, politically there was a need to get the man in the street investing in these type companies. Therefore, they were priced at very attractive levels. That is exactly what we see occurring in Europe over the course of the next few years. I would estimate that between $50 or $60 billion of companies will be taken out of state sectors and put into the private sector, mostly in Western Europe, but also including some of the most attractive opportunities in the Eastern European bloc. That really is going to be a terrific drive to get individuals investing in European equities, both domestically and internationally.
Next, the Pacific Basin. From the new economic powers of Thailand, Malaysia, and Indonesia, to the biggest potential market in the world in the form of over 1 billion Chinese, Asia is an awakening giant. Covering the Asia-Pacific region for Merrill Lynch Asset Management is Senior Portfolio Manager Karatan Bala.
Well, in the 1980s, Japan proved to be the engine of growth for Asia. It relocated a lot of its manufacturing plants to Malaysia, Thailand, and Indonesia in order to capture the cheaper manufacturing costs in these countries. In the 1990s, however, I think China is going to be the engine of growth for this region. We've seen growth in the 1980s, but growth is now going to be even stronger and is going to expand to more countries such as Philippines, Vietnam, Hong Kong, and Korea is even going to capture on the growth of demand in China. The demand growth is going to come from consumer spending. The consumers are hungry for consumer durable goods, and these are going to be provided by these countries which I've just mentioned. Along with that, China is also a very cheap manufacturing country because of the low labor costs. So a lot of companies that are now operating in Thailand are going to want to move to China in order to capture the cheap labor costs. Besides China, there are going to be three very important reasons why growth in Asia is going to be strong. The first reason is infrastructural spending. We have countries such as Thailand, Malaysia, and Hong Kong spending great deals of money on expanding their airports, building new airports, highways, and expanding their telephone lines by the millions. The second reason for growth is export-driven. They are manufacturing goods such as semiconductors, textiles, toys, and exporting it to the West as well as amongst themselves, so that intra-regional trade is going to be a very important factor in spurring growth in the region. The third reason for very strong growth in Asia is consumer demand. The consumers in Thailand and Indonesia and Korea and Taiwan even are in demand of consumer durables such as VCRs and TVs and washing machines. For these three reasons, we're going to see very strong growth in the region, and it's going to extend through the 1990s and even into the 2000s.
Lastly, Latin America. Free market reform has led to more balanced budgets and comparatively reasonable inflation, which in turn has helped to attract capital back into the region. Additionally, governments are selling ownership stakes in state-owned businesses. All signs that Latin American countries are committed to free enterprise. The senior portfolio manager specializing in emerging markets for Merrill Lynch Asset Management is Grace Pineda.
Now, what Latin America has to offer that's unique compared to the rest of the world is a huge population. Altogether in the region, there are 400 million people, and the average age of that population is less than 20 years old. Furthermore, there are a lot of natural resources in the region. These include petroleum, iron ore, and copper. Altogether, Venezuela, Mexico, Chile, and Brazil own a large share of those resources in the world. The proximity to the U.S. means there's a lot of room for trade and investment to grow. There's a lot of need for U.S.-made capital goods and U.S. technology. At the same time, the U.S. needs a low-cost labor pool of Latin American countries. Political stability is improving in the region as the countries become more democratized, and also as consensus for market reform grows and as the military becomes discredited. And finally, there's a lot of room for the stock markets to grow in these countries. In Brazil, for example, the stock market is only 8% of the size of its economy. Contrast that with the United States, which is 80%. Companies are being privatized, incentives are being created to list in the stock markets, and investors are being given incentives to come in as well.
For individuals considering investing overseas, there are a number of ways to get started. Individual shares of a foreign company can be purchased. These are traded on a foreign stock exchange and are denominated and must be purchased in the local currency. Gaining popularity with American investors are American Depository Receipts, or ADRs. With an ADR, a U.S. financial institution, such as a bank, buys a quantity of a foreign stock. It then issues receipts, or ADRs, that are priced in dollars and are traded in U.S. markets just like any equity security. Defined asset funds, also called unit investment trusts, or UITs, offer portfolios which are professionally selected and that should change very little over the life of the portfolio. When buying a defined asset fund, investors know in advance exactly what stocks or bonds they own. Because of this, The expected income and maturity of each portfolio is known at the time of purchase. Finally, there are global and international mutual funds. Global funds invest in securities anywhere in the world. International funds invest only in non-U.S. securities. With a mutual fund, investors get professional management and broad diversification, two benefits they are unlikely to be able to afford on their own. If you've limited your investment choices, consider these facts. The globalization of the marketplace is creating more opportunities for investment. The world's capitalization is increasing, and the U.S. is now representing a smaller piece of a larger pie. Some markets overseas are growing much faster than the U.S., offering investors the potential for increased performance. Non-correlation with U.S. market cycles can help reduce volatility in the value of a portfolio. Diversification can extend beyond borders and can decrease overall risk. And there are a number of ways to participate in world markets, enabling you to meet your investment objectives and risk tolerance.
We're going to be totally economically interdependent, and that's going to be a very exciting world. We're going to have a period as we move through the 90s into the next century of some of the greatest economic growth the world has ever seen.
The central thing to keep in mind is that the basic forces that have driven globalization of international financial and product markets over the last 20 years are, if anything, intensifying right now, and that we'll be seeing more, not less, globalization over the next 20 years.
The United States only accounts for a quarter of the global economy. Why should you have all your assets invested in the United States? By spreading your risks around to other countries, you can reduce your total risk while not necessarily sacrificing any return.
Look, the globe is coming together all into one general global market economy. That's the message that we really are, that makes international investing so exciting. A way to participate in this coming together of the global economy, the opportunities that it affords us and presents us with. But basically, at the bottom line, at the end of the day, there are really three reasons why we look at international investing. It's number one is opportunity, number two is diversification, and number three is performance.
If your investment world has been this, perhaps it's time to consider the case for global investing. Your Merrill Lynch financial consultant is trained in the use of global investing to fit client needs and can help you plan a global strategy designed to meet your investment objectives. For printed information about global investment strategies, call our toll-free number, 1-800-MERRILL, extension 5332. That's 1-800-MERRILL, extension 5332. You'll receive special Merrill Lynch Symposium reports and additional information about specific investment alternatives.